Hello, everybody, and welcome to our first public live stream that I've done now with the Contrarian in some time. I think it was maybe early December or maybe even November since the last time I've been on with you. How you doing, Bob?
Great. How are you doing?
Doing fantastic. We're here this afternoon, wherever you are, to check out some basically global macro views and kind of talk about the socio-political events going on, maybe talk about what the breakdown that happened on the New York Stock Exchange this morning and kind of go a little bit overview on that. And then we'll move our way into the stock market, commodities, and then we'll finish it out with cryptocurrency. So everybody here, thank you for joining us. Bob, what's your current take on the markets? What are you seeing? What are you thinking? I know you've been traveling and sitting in the sun and hanging out with your buddies the last few days on a vacation, but now that we're back at it, I know you've been gone, but what are your thoughts on what you're seeing in the markets?
Well, hello everybody. Even though I'm gone, I'm always, got an eye on the game. So, just to let everybody know, we just went through the Chinese New Year on January 22nd. So I expect this week China is just going to be celebrating the unlocking of COVID, so to speak, in their country. I expect consumption to continue to excel. You can see that in some of the food prices we'll look at a little later on. With that kind of backdrop, China's government is the only country that's still easing interest rates. So they're trying to facilitate consumer spending. 11 billion people coming out of COVID. Everybody knows what we were like when we came out, and they were actually locked up an extra year. So that's going to carry consumption, which is going to be a shot in the arm for the world economy to an extent in certain sectors. But outside of that, the rest of the world is going through retractions. They're raising rates. Our Fed has a meeting February 2nd. I believe they release, everybody's expecting a 0.25% rate hike. Right now, the Fed funds is around 4.3. The projection is that they're going to get up to 5.25, 5.5. The stock market has shown very good resilience over the last since the beginning of the year, actually, and it continues to look good. The S&Ps look like they're going to test the 4,100. Net, we're only down about 18% from all-time highs. That's just hard to swallow. That we're so close to the old highs based on the dynamics that is the world economy with higher costs of funds. So I still believe personally you're still not too late for another leg down in these markets. A lot of this money that's been on the sideline has been put to play by a lot of managers that took a beating last year, and they get paid on performance. So they're just reloading. Some of the sectors have gotten decimated, from Meta to, even Apple to an extent, Amazon, Google. So a lot of those, the dogs of last year have become the darlings of this year. That's anybody who's familiar with portfolio. Nope, sorry.
Ding, ding. Somebody's making money.
Train just came on through. But anybody who's, managing a portfolio, when you rebalance, basically what rebalancing is you buy the dogs and you sell, the winners, and you rebalance to that, whatever your ratio is of, if you're aggressive, you're 60%, risk on, and the other 40 in a conservative bond, mutual fund, things like that. So that's kind of what, we've been seeing, re-engaging based on the dynamics that all the analysts believe we're going to have going through 2023. They've gotten a little more bullish, and you can see that in the charts. But the fact still remains that the Fed is still raising rates. We really haven't seen the true effects. We've gotten some early indications just in the in the real estate sector on from new home sales and existing home sales, that the higher rates have definitely had an impact on that sector. In China, I believe I saw that they've had a drop at about 65% of their demand fall off. And but what they did is they just leveraged their developers. They kind of have to have the same requirements as our banking system. In other words, you have to have X amount of reserves based on the amount of loans you're taking out. Well, China just approved that they were going to lower their reserve requirements, which in essence is giving all these developers more cash on hand to keep building. There's no demand for it, but again, that's what they're trying to do to facilitate, people going back to work. And so that's an interesting dynamic that's happening in China. Outside of that, we still have the pretty diverse globe with Russia and, the United States and China not getting along. There's been tensions in certain parts of the world that everybody's aware of. Taiwan is, people think that China's going to make a move this year. So all that stuff's in the backdrop. Of course, we also have last Thursday, we hit our debt ceiling limit. So the U.S. government right now is basically broke, and Congress, you need to approve it in order to expand it. So that's another element that I believe June 15th is when all this, what I'll call smoke and mirrors to try to cover that time frame before Congress approves an expansion. Because if they don't, we basically default on all our debt, which would be devastating to the dollar and to the integrity of America debt. So with that as a backdrop, Ax, why don't you just drop into some comments?
Sure. Thank you for the overview. That's beautiful. Firstly, lately, I've just been basing most of my analysis on the technicals, because it's easy to get caught up in the narratives and everything that's going on with the central authority figures. So, I'll pull up my screen share now and show you guys the dollar currency index, and just some notes that I have on it is that this is a monthly chart. And so, as you know, if you don't already, when the dollar goes down, money comes back into risk assets such as the stock market and gold. And gold would be the safe hedge against a falling dollar, for example. So not really a risk asset in that regard, but the money leaves the dollar because it's no longer becomes the safe haven, and people stop storing cash. And I think this is also reflected in housing prices being down, because when housing comes down, that's kind of what the aim of the Fed was in raising rates, was to get this overheated market to come back down to base valuation. So now that some of that's getting priced in now, the early movers are taking their shot and they're moving their money out of the dollar and they're going to put it into things. So just when you see something like this on the monthly chart, you're like on the dollar, I'll go ahead and point out that anytime that the 21 monthly move, or let's say this is a 24 monthly moving average. Okay, so this is a yearly moving average, just a 12 month, right? So anytime that you see a red candle close below that level, you see a typical 10 to 12% drop off, essentially, from the candle that started above and closes below. And you'll see that again over and over. So going back to February of 2000, when the massive .com crash happened, that was actually a larger move, and that the precedent was set then for this trend to begin. And then there was another one that happened in 06, and that was like a slightly larger move as well. But then every time since then, you've seen this 10 to 12% move, and on average, it's sitting 11.5% in the past three events of it. The past 4 events of it have been 10 to 12%. And so I'm just, basing the same theory going forward, basically applying historical market cycles and psychology to in the same way, since we've had this nasty breakdown on the dollar on the monthly chart, and the fact that it's going to close in 7 days, potentially below that 12-month moving average, you could expect the downside on the dollar to be another 7 to 8%, and that would land you on that 93 support level, which the price of the dollar has been oscillating on since 2015. So this tells me that there's room to run on risk assets, and on crypto, it's showing it's rearing its head for higher prices. And with the stock market showing resilience, I'll go into that now. You can see that the stock market is like one place
Can you do something real quick? Can you bring up the Japanese yen chart? Because
Sure.
that's what it is again, I believe the dollar's got more downside, and if there's a resolution on this debt ceiling, the acceleration could be incredible. But the yen has been, the dog of the currency markets for probably 30 years. So it's actually, and the Bank of Japan has acknowledged that they're looking to raise interest rates. So they're actually the slowest start recognizing inflation, and they'll be the last to turn off the rate increases. So you're actually going to see the value of the yen go up. It's had a nice move, but I believe it's just at the beginning.
Yeah, 90. It's up in 90 days. It's up 18, 17%, which is a huge move. So that's obviously been reflected in the dollar, and then the other currency that's also competing with the dollar is the yen. So because when this chart goes down, it actually means the yen is strengthening against the dollar.
Yeah, and that applies to all currencies that are going to be gaining on the dollar.
Yeah, the Russian ruble's found support on its upward trend here. If you kind of ignore the anomaly of whatever happened in March of 2022, it's recovered a little bit and going higher, and then the euro as well is going up to test the upper of its down channel as well. So the dollar looks like the weak one right now, and it's coming off of like a many month. Let's see,
And that's why
600-day move higher for 30%, which is just crazy in the forex markets.
And if any of you have been following other news sources or anything, or investment, they're actually touting now international investment. I think that there's a better appreciation, and again, it's partly because of the inversion of the dollar. So basically, foreign currencies should get stronger based on the dollar, and those companies that obviously sell in those currencies are going to make a higher percentage of profits versus the ones that are in dollars. Multinationals, obviously, they hedge the currency play, but again, just smaller companies within those regions will, in theory, have better, stock performance as opposed to the U.S.
And with that said, I mean, even the U.S. stock market here, this is a composite index of 4 of the major indices. It's holding this level, which is the 0.618, and anybody who knows Fibonacci knows that 0.618 is a key level that things go back-to-back test, and you can see that it's back tested repeatedly since 2008. Once here in 2010, again in 11, again it got tested twice in 2015 and 16. It got tested again in 2019, and then it finally broke through with the massive COVID pandemic crash. And so that because this support is held for so long on this rising channel, this Fibonacci channel, and now you've caught support on it yet again, it just seems to me that this is an opportunity with a falling dollar for people to capture some profit here going into tax season.
I mean, the $1 million question is going to do another leg up or leg down. I believe it's a leg down. Where it is in the relationship to those bands says that it's, should work to a lower band. And again, the factors that will help that is the rates. And what the Fed is doing, they're willing to take it down. That's the whole point. And like I've said for quite a long time, inflation is going to be around longer, and we're going to have a higher rate of it. They're not going to be able to get from 6 to 4, let alone 4 to 2 is where they want to go down to 2%. So, and with the Fed funds rate again at around 4.5, that's another 3/4 rate hike. So we haven't even started to see the impact that these rate hikes are having on financing businesses and loans and everything else. So this is still early, and that's why I hold out that you're not going to see the push through of these rates in the economy for another year or so. So
I got the Fed funds rate up here right now, so people can see kind of what that looked like over the last few years. So for those that don't know, when the rates are high, it costs more money to borrow money. So then because money's getting more expensive, there's less money and liquidity going around. So the way we pair this Fed funds rates chart with the money supply chart. And as you can see on the money supply chart, there's less and less dollar liquidity in existence. And so it's because this number's falling, that should put pressure on extra expenditure. So any extra money that people are going to have is going to be going to paying for these inflating prices on things that they need, goods and services. Food is going to go up, oil is going to go up, and generally your cost of living is going up. And so the only way to combat that is by increasing wages, but because only the private sector really has control over that. It remains to be seen how far the crash would have to go, and how tightly the liquidity would need to be squeezed in order to see a bearish or bullish outcome, right? So I think the way that the best way to look at this moving forward on the as far as the indices would be, you could expect a rally short term to go test back this highs at the 4,400 level on the S&P, and then maybe try to chop higher. But you're going to run into some major resistance, and where you're going to see a massive sell off, I think, is what Bob is kind of anticipating in the next few months.
Yep. And that's the whole thing. Everybody's trying to, everybody knew that, things would be rosier this first half of the year. But what's happening now is everybody thought, we'd be through it. In other words, the worst news would be the first half. But the second half, people are starting to realize, again, when I say people, the experts are starting to realize that it doesn't look as, as easily bounce backable as everybody thinks. So, I think the reason is because the interest rates, I think what's going to happen, what will actually facilitate a panic, is when they start seeing these numbers and how severe they've been cut. And we've only really seen a couple rate hikes go through. And there's still, let's say 2% more of hikes to come through the system. That's when they're going to, probably start to panic and readjust. And again, it's always been stated that these earnings per share have been based on too high of a multiple. So those, that's what everybody on Wall Street's waiting for, is them to, bring down their guidance, which in effect would bring down the values of the market. So until that,
is it not? And correct me if I'm wrong when I say this, but has it gone way past just speculative highs, and now it's almost like inflation is now more baked into price? Or do you think that inflation is playing less of a role in all of this massive move in the stock market since COVID was speculative interest based on easy money?
The reason why this market ripped was because money was cheap. And so you had nowhere to go with it. So people put it in the stock market. But again, during that time, what the companies were doing is the Fed said, hey, give me any of your debt, I'll buy it. So they were basically buying whatever companies would write in terms of debt, and they would buy them and they'd give the companies cash, right? But if cash is so liquid, they would just take it and buy their stock out of the stock market. So if there's less shares, the shares are more valuable than the stock. So with companies, and you can go back and see how much cash Apple was swimming in, Amazon was swimming in. I mean, they weren't making anything on it. So they were going into the market and buying outstanding shares, which artificially raises.
Same thing happened to cryptocurrency.
Well, that's what happens when money's cheap. Everybody inflates the price of stuff because the currency you're actually using becomes worth less.
Yes.
And it becomes devalued. Now what's happening is, instead of having all this currency out devaluing the value, the purchasing power, the product side is what's expensive because of inflation, because those raw materials have now been added. Those costs have been added to each unit produced. And in addition,
that's a good time to bring up the commodity index to show people what we mean. Like, this chart's literally showing you the cost of all of the things that goes into creating the products you use on a daily. It's gotten more expensive since COVID.
Well, I wouldn't say all of them. These are a basket what are listed as commodities, but like eggs aren't going to be in that index. But right. There is,
But that same theory applies to eggs.
Yeah, and if anything, eggs have been the number one commodity. It's up 60%, which is staggering in the last 12 months. So that's why I keep emphasizing there's certain sectors are going to, not get hammered anymore. I mean, I personally believe that the FANG, or whatever you want to call them, won't go down as severe the next down leg as some other ones. But other sectors like real estate or construction, they're in a depression right now. So that's what I think is going to be different this time around. It's not going to be like, 2008 had to do with our financial institutions across the board. Well, they controlled the whole game, right? So that's why everybody felt it. This time around, I think it's going to be secular. If companies are heavily into debt and they financed it for years with cheap money, those dynamics are going to change. So what I would, people like to do research.
Yeah,
Go
we need
look.
to be doing research on those companies like that
Yeah,
are
you
overly
want to
indebted
go.
because there's no way they're going to be able to pay back their obligations now that,
Yeah,
rates are
and
so
this
high.
gets back to Carvana. I brought that up before. Carvana was a $200+ stock back during COVID. Now it's on the verge of bankruptcy, and it will go bankrupt because getting back to what I was talking about. They have debt that's coming due, and now they need the cash flow, so they need to refinance it. But not at 2%. They're going to have to refi maybe at double digit. If they don't make enough income to cover that interest rate, it's no different than if we go heavily into debt on our credit cards. If we can't even make the payments of the interest, what's the likelihood we're going to stay afloat? And the companies, a lot, it's the same dynamic. I think it's only more enhanced by the fact that it takes money to make money when you run a business. You need the cash flow for daily operations. So that's the thing you want to look at. Look at these companies that are over leveraged, and when their debt matures, and you have access to all that. That's what's so nice about technology now. You can go to Moody's, and Moody's will give you rankings on companies, and they'll break it all down to you. And that's why I said there's resources out there. Technology has never made it easier to do the research. And once you have the research, you can do your own analysis.
Is this
And
it?
yeah, let me see what it is.
What do you want to pull up? If you give me a sector.
Well, you want to pull up Well, I'm trying to think. The sector that's probably going to be impacted the most is the Silicon Valley.
Technology sector.
Yeah, because those guys, they're the ones that are cutting all the labor forces because they've been spending money, because it was cheap. So it'd be interesting to see. Obviously you can't do the primaries like Meta or Google and stuff because those are the premiers, but there are some that are under that, some within the same sector. I don't have any off the top of my head, but what you're able to do is you're able to see on their, financial statements, how much debt are they carrying, whether it's short term or long term. And
Yeah, a lot of this is locked up, but I can see the value.
yeah, as a percentage, because you want to, the easiest figure to find out, you want to know what percentage of debt is their company on their books, and all of that debt, how much of it is coming due in the next 3 years? Because that's going to give you an indication. Just is there a lot of pressure on them to have to, replace that finance, or some may be financed, out 20 years, and it's not going to be an issue for them. So those are some of the dynamics you can do research on.
There you go, guys. Moody's for sector research. You can look for guys that are over indebted and basically capitalize on their failure, or find somebody who's going to come along to pick up the tab.
Or what you do, again, you watch it, you monitor it, and you see, because you'll get clues. Because right now, I think that's what the bet is now. Some people bought some puts on Carvana because I believe they have debt coming due in March, and their stock rallied to $8. That's the other thing that's insane. Bring up that stock. In the last few days, it rallied from like $2 up to $8. Nirvana, I'm sorry, Carvana. Hey, I'm stuck in my 70s with Nirvana.
It's all good. They rock.
We should have a back music.
Carvana. So this is a monthly. Let me pull it in a little bit here. We'll go to a daily. Nice little rally off the low.
Yeah.
134% for a stock, not bad. But you got to remember that there's about a few thousand people above you just trapped as hell.
Yeah.
Price is still down 98%. So
I believe this company will go out of business, and the reason being is they financed a lot of debt that's coming mature, and their stock, is getting crushed. They owe creditors and everything else. So
let's talk about something more positive. Like, look at Tesla, how well it rallied off that low. I mean, we called for this privately that the $100 level was going to be a significant level, and we got a nice rip off that bottom level.
Called
46%.
Meta. Called Meta.
Yep. We've been all over these calls. Yeah, I mean, we can go into specific stocks, all day, but I think the idea here is to teach people the methodologies about where to look for opportunity.
Yeah, but all I'm going to finish up with, when you get all your research and do your own data, you'll find that if you want to participate in an option, because I'm trying to bring something viable to somebody who doesn't have a lot of money, and does research, and they're willing to determine the risk parameters. and you're able to get in, and because a lot of this investment, you need to be a whale in a lot of circumstances, but there are ways for small guys to trade, and that Robinhood is one way. And so I'm just demonstrating, if you watch things like this, it's not something that's not going to happen today or tomorrow, but if you keep an eye on it and you'll see the shifting occurring, and that may present an opportunity that with a reasonable investment you can take advantage of. So that's the objective here.
Yep. And so I guess since you guys have been sitting in here long enough, I'm just going to show you a cool little analysis method that I like to use when I'm measuring things, and just show you kind of how this has played out so far. So this is the daily chart for the S&P 500. And what I have on here in the yellow is this band is the 21 daily moving average, which would be a bull market support band. And so all I was looking for going back through the past of this downfall was any time that the price closed above that level, and then the amount of percentage gain until it reached its peak. And so if you do that over and over, you can see here that there was multiple occasions where you went anywhere from 4% to 13% move to the upside. And so we most recently had a close above back on January 10th, which was just a week and a half or so ago. And before even this played out, we hadn't even come back down to test again. Now we've had a successful retest on the 20th, and it's going higher. And we just measured back to 2021, where these key levels were the key high level here in March of 21, the key wick lows in May, and then the key wick low of June of the same year. And then you project that out forward to see where we're going to be playing with as far as resistance and support levels. And then you can kind of measure off from here, as with this successful retest that you had right here on the 10th, that was the 20th, you can assume that on average that the price moves 8% off the 21 daily bull market support band. So this would be an automatic long off that level, off the candle close on 23rd. So that was, that was yesterday. And so now you can, if you would have taken that trade, you'd already be up anywhere from like 1.5 to 2%. And if it gets above this resistance level here, which it could not here in December, but if it does, the next move up is a nice little 2.5% move to the upside before you start getting into the riskier territory of that 8% average. So that's just a quick way.
Where's that resistance now? What number is that? No,
41.
Not way up high. Yeah, I got 40.
One.
Yeah,
40. One. Let's see. I'll give you the exact, so you know.
40,
based on
50.
this data set, we're looking at
because I got around 40, 50, and then
40, 36. 40, 36 based on that previous, let's see here, 40, 42, somewhere between 40, 36 and 40, 42. If you get above that and hold that, test that as support, get up here, you get like halfway there, you break back down, you run into the moving average here. As the moving average increases, the price comes up and then comes down to retest, and then in February, if that holds, then you get a rip up to these general regions here, like the 4100 level, 4200 level you'd be playing with. So there's
because we're there right now.
This is an inverse head and shoulders pattern. You got the low, and you got a lower low, and then you got a higher low, which actually even beat out the previous low, the two previous lows. So now this is looking to be a reversal pattern to the upside, and so this is like a key zone where when you saw the successful test, you would want to take a long position. And this isn't saying that this is going to go long for the rest of the year. This is saying that you have short-term upside. So kind of one way to take a look at that chart and how to analyze it based on the 21 daily moving average.
Yeah. Well, it'll be interesting to see if that's not an ABC move before we go back down too. So.
We have a question here from Cosmic Duality, Bob. He says, what do you think Microsoft earnings is going to be? Seems like tech stocks are rallying a bit. Pull up the Microsoft chart. This chart doesn't look as good to me, but it did get above the 21 daily bull market support band.
Yeah, I know some people have been turned bearish on Microsoft. I think I don't know if it's in Europe, they're in litigation. They're trying to buy a huge gaming console business, and I think in the EU thinks it's monopolizing and stuff. I think people in the US, like it, But so anytime you do a big deal like that, you wonder. Some people will think they're not focused on what they do best, even though they do Xbox, which is fine. But
I mean, they've already acquired. So it just, this is my domain as gaming. Like the Microsoft acquired, Activision, or no, are they going after Activision Blizzard? But they acquired Bethesda, which was another massive software developer a few years ago, which was like basically the beginning of them conglomerizing like the entire gaming space. And if they were to acquire Activision Blizzard, it would very much look like a monopoly because they're one of the biggest competitors of Microsoft. So then it's really becomes like once they own all the software production companies, then what does their competition have left? Nintendo creates Nintendo games, Sony creates very little games for themselves. And so I think like that's kind of the concern, is that Microsoft would be completely dominate the space.
As far as Microsoft's one, I think that can, with an Apple on the same format is can have another push lower. The other, that's what I think on those two. The other ones, like Amazon's been beat down pretty much. Meta is a stock that got into the 80s. I don't see that getting back there. But there are, again, valuation wise, Microsoft could come down and Apple could come down. Once they do, I'm sure, again, people will be there gobbling them up.
My thinking on that Microsoft play is that in August of last year, you had it gapped up higher above and created an island top to make a secondary downtrend line. And then most recently in December, it gapped up again, but it was up there for a shorter amount of time and could not hold that key support level. So to me, it's testing it again now, that downtrend line in a shorter period of time. And so the chances of it getting above and trying to go back to retest is actually quite high before ultimately coming back down. And I don't think earnings has as much to do with it, in my opinion. And this is just an opinion, of course. I don't trade on this, but my opinion is that it can get up before it retraces, just because of how quickly and how aggressive it is to come back to test this line consistently.
And the other factor is it's your timeline, because if you just look at the overall picture of this chart, it's in a downtrend. So yeah, you can have minor counter trends. I'm more into the general trend, and you can see where we've come from, and where I put all my weight on is these valuations need to come down because of the cost of money. The cost of borrowing has just gone up, better than tenfold, and I don't think it's priced in the values of companies anymore, because we could drop 50% here, and based on the new cost of money, that could be the new fair value. And that's what I keep emphasizing here. People don't understand that, the whole thing behind interest rates is everybody knows $1 worth less in the future than it is right now. And that's based on certain assumptions, but now when you've totally distorted the interest rate, or the way we do business with the cost of money, raising it so fast, all these assets are still trying to find where their new equilibrium is based on that new environment. And you can't tell me that's been done in a couple months.
Yeah.
It's just, you're telling me the market has corrected it faster than
Can you see my screen, Bob?
Implemented it? No way.
Can you see my screen?
Yeah.
You see the orange line? That's the Fed fund rate. And you can see that the Microsoft stock price since the 87. So you can actually try to look at this for correlations, like when the Fed funds rate peaks and what the Microsoft stock does. So when you get these pauses, it usually marks a significant moment. But we know that we're not for sure paused.
Historically, when rates go up, tech goes down. Why? Because tech is the most leveraged of companies.
Well, look at the chart, Bob, right here.
It's all R&D. So that's money that's not going back into the shareholders' pocket in the form 100%. Of a dividend or anything. So they're burning cash, and it's costing them more money the higher the rates go. So no, tech are going to have trouble. That's why I say, based on their valuations have been in a negative interest rate environment. And if people believe, that's why he kept saying, we've only corrected like 19% from our all-time highs. And that's absurd considering we've raised rates. We went from negative or 1%. Now we're going up to 5.5. You cannot tell me that all asset classes have already adjusted that. And that's why I'm saying, I don't know what these markets are doing. That's why I'm called the contrarian. This is why I go by the contrarian, because I'm steadfast in my analysis, and my timing's usually early, but I don't. If you believe that last October was the all-time lows, I just don't buy it. So
let's just look at this chart. So like when the rates go up, like we're here, for example, in 1999, the rates bottom and then they go up. Well, what happens to Microsoft? It starts to roll over and then tops and crashes. Make sense? What you're saying is true of 1999. When rates went up, Microsoft went down. And then again in 2004, when rates went up, Microsoft stagnated and then broke down. It's pretty much stagnated through this whole period.
Oh, it stagnated for almost 20 years. Microsoft went nowhere.
And then here's an interesting time period between in 2015, as rates gradually increased, Microsoft stock actually went up with rates. Why would that be?
When was this?
2015, from the bottom, when rates went from 0 and they started to gradually increase, 16, 17, 18, 19, Microsoft stock just wasn't going on a parabolic run. But it's different.
You want to know why? Because that was 10 years after the dot-com bubble. So again, that had an industry that affected everybody. And so once people started buying the best in breed, you probably got the response higher. And relatively speaking, interest rates were still a lot lower in 2015 than they were right after the dot-com bubble. I mean, I should say they were higher, but relatively speaking, they still kept them low because we did have a mini recession between 2000 and 2003. So, and that's when it was actually under Bill Clinton. They relaxed the reserve requirements for banks because they wanted to facilitate consumer spending, and that was the beginning of the housing boom.
Mm-hmm.
So,
anyway, just interesting. So this is one way to measure for yourself. If you want to go back and you want to compare the Fed funds chart to like any chart, you can see how that stock actually was affected by rates over time. And then you can kind of make your hypothesis from there. So I'll take that down. So we've talked about the stock market. I wanted to actually touch on go back to commodities for a second, because we didn't really get into the juicy details of that. But right now, the commodities are basically in a bull flag. So I think this is like deflating. This is commodities deflating from like an insane rip up, basically since COVID. They just topped in summer of last year, which also was some of the biggest moves down on crypto, ironically enough, were during that summer. And so now that, inflation's trying to be priced into these, like we can go take a look at actually specific ones. Like I think copper's been on everybody's mind for a while now.
Yeah, again, that's something we've covered, quite a while. I've been bullish on it. It's acting the strongest out of any of the metals. Again, that's a industrial metal, and it's more sensitive to everybody's assumption of the reopening in China and manufacturing. And if you look at the long-term charts on copper, it's really at a median price, actually around 5 cents. But so again, that's got upside. Excuse me, we've been bullish gold and silver. And
gold's had quite a rip. I'm just trying to basically show people some sort of a forecast based on what we know for sure about the economy, which is that inflation is here to stay. Like, it's not going away. And the only way you can combat it is by raising wages.
No, that's not correct. the only way you could combat it is by getting people out of work, so there's people aren't making money, because it's consumption they're trying to kill, and it's that the only way you can kill it is if you put people out of work. That's
Which is
how.
happening across the whole tech industry.
Yeah,
So
yeah,
thousands of people
and
lose their
that's it.
jobs.
The dilemma they have is, in order for it to be a meaningful effect on inflation, you need to basically lay off more people than jobs. And right now, there's 10 million jobs extra. So that's where they're having trouble here.
Yeah, but the thing that we're not realizing is that there has been efficiency increases into technology, so that even though people are losing their jobs, you know, the efficiency increases are also being priced in at the same time.
Yeah, but what can I buy with efficiency when I'm out of a job?
They don't care about you. You can go die for all the Fed cares. That's the
You,
point. And
no,
so
no.
that's why
The
they
point
get
is
left behind.
ultimately technology can make everybody without a job, and then it's like, well, how do you keep the economy going if nobody's working?
I mean, on the surface, it looks like that. Yeah. I mean, you're always going to need, well, I shouldn't say always, but for the immediate future, you're going to need people to do tradespeople work. Like, you're going to have someone come do your plumbing. You're going to have someone come do be your electrician. You're going to need people to put a roof on your house. You're going to need someone to grow your food. And that stuff's so baked into the economy that really all you're going to see is the prices of those things go up anyways, because the demand will always meet or exceed. No matter what they do to jobs, you're not going to stop the amount of mouths that need to get fed, and the government will come in and subsidize that in any way they need to keep the population happy.
All right. Well, I'm just going to stop there because I'm more about market analysis than, that gets into a whole different realm that I don't, that's bordering on political, because when you think governments are going to take care of you, I think
Well,
you're.
they want you to become dependent on them, and so that's why I think like a lot of these prices are actually you could see like a crash, but the way that debt is structured, you're always going to see some big player come in and absorb it and create a new floor, which is why cryptocurrency has continued to go up for a decade plus and never really broken. Look at this chart, Bob. This is Bitcoin. Like, it's only went up forever. Like, my thinking is that a lot of these prices are trying to get baked in, and no matter what the government wants to do to increase rates to like kill jobs, those people that are still working are going to have to still find a way to pay for their living expenses at the new prices. And that means that companies are going to have to pay more to keep their labor. At the same time, technology is eliminating the need for labor. So it's like competing forces working against each other, I guess.
I don't know. Like I said, I don't want to go that far. I just stick to the charts. But yeah, so again, if you want to bring up some commodity prices, again, gold and silver are looking good. Silver actually had a big sell off, I believe Monday, went under $23, and my hunch is it may have negated that accumulation, but then it just it came screaming right back in the next two sessions. So I think it's a breakout above I think 24.50 on the silver, and you could be up to $50. It could double from there. Same thing with gold. I think there's a little resistance around 1960, but 2010, break 2000. I mean, those are significant, achievements considering how long it's taken since the last time we were there. And, but it also, gets me to wonder if metals are rallying like this, especially gold and silver, because they're the ones that hold the value of the inflation impact better. And the stock market's rallying. What message is that sending? Because if gold keeps going up, that means the fear of the worst case scenario is becoming more and more reality. Because what that basically says is people are betting on inflation being higher for longer. And if that's the case, equities cannot, again, their price earnings are at levels that don't take that into account. So either copper, or excuse me, the metals are wrong, gold or silver, or the equities are wrong. And I see how the bonds have reacted. All these other markets are telling me we're in for more harm than good. And that's why I think equities, the risk assets, except for gold and silver, because they're being used again as a hedge against the inflation. And you have other, again, the CRB showed you got grain prices, all these commodities, these necessities are at, just ready to break out to new highs. And on a seasonal play, we're ramping up into February where, the weather factor is going to be more prevalent. So you could bring up the meat chart, cattle's up near its highs. The seasonals of those are supposed to kick in on the 29th of January. They've actually, out of 15 years, the last 15 years, 13 of them, this seasonal trade has made money. And that's basically long the market January 29th and be off by mid-February. Now that's a pretty good percentage. Do I play it? No. But, you can read on this stuff. It gets back to doing research on markets, especially if they have a seasonal tendency. Because what we want as an investor is the best analysis and the best probability. That's all this really is the probability of it's going to go from point A to point B.
Said mid-February?
Yeah, like around I think the 19th maybe.
I'm literally going to go back in time and figure and just put a vertical line on every February going back and just see kind of what the chart did. So yeah, I mean, look at this stuff. You could see an obvious correlation with what you just said. Going back each February, mid-February. The top actually happens in January or February, typically. This one was bang on last year. Literally topped second week of Feb. Year before that, I mean, there was a big rally going into March, it seemed.
Yeah, and today was an interesting day because they were all lower, and even the hogs were lower. I mean, the hogs have just, no pun intended, but hogs have been slaughtered over the last month, and it doesn't make sense to me. Again, I'm the contrarian. Something's not making sense to me, and what it was is you got the reopening in China. Everybody's going to be eating. They also have their Chinese New Year, so nothing but good news and they love pork. And again, hog prices have been selling off. It just doesn't
pull up hogs here.
This doesn't make sense. So I believe that this is a big pennant right there, and it's going to go to the upside.
Oh, for sure. I totally see that.
So again, your analysis and some fundamentals. I mean, look, we're right down to that trend line, and what we're going to do is probably chop around for another 3 months into the 3/4 of the apex, and then take off. So,
I mean, you see the same pennant pattern happen back here, kind of. It's actually it's a trend line that goes back to 2016. With granted, you take out the anomaly here of whatever this was, which was in COVID. Shit, you get a nice COVID event, you see a crazy wick low. They go long hogs.
Yeah. So again, to me, food prices are a far cry from real estate, mortgages, because you can look at the mortgage market. Yeah, that definitely had an impact when the rates went up.
We had a comment here on gold, actually. I kind of wanted to go more into deep on gold because of how important that chart is right now. The comment was something is consistently buying the volume weighted average price on gold. I don't know if you know what the volume weighted average price is, right?
I think
it's basically like where the price trades the most on any given day. So it's like it's an average of.
Yeah, it's the mean.
Yeah, pretty much. And then obviously when you're in a bull trend, that number goes up every day. So something has been, and I can tell you what my intuition is on that, and that is that there are other governments that are abandoning U.S. sovereign debt, and they are accumulating gold. Probably even our own government is accumulating gold.
Just let you know, all the world banks have been acquiring gold for the last 6 months. So you're right. That's exactly what's going on. And it enforces my belief that which is a benefit to crypto land, that just the integrity of governments backing their currency when basically there's nothing backing it, it looks weak. And especially what the Fed's doing now, it makes them look weak. That's their biggest problem, is they're going to stick to higher rates just so people say, oh, look, they're flipping under political pressure, everything else. Right now, they look weak. They were accused of taking too long to, raise rates and all this, that, and the other thing. So just the institution itself, just like every other institution in America, is at stake because, when people start losing faith in it, it destabilizes things. So why should the dollar be any different? And again, it gets back to this debt ceiling. If we get to a point where there's an impasse, the damage is done at that point. Last time they had a ceiling issue and they tried to debate it, S&P's downgraded U.S. debt. So, I mean, it's a real thing here. And I believe it's going to become more apparent the more we go into this early part of the year that that's going to be the noose around the stock market as well. So,
yeah, I'm just putting a fractal on gold here. I mean, there's nothing saying that this is soon to be the top on gold short term.
Oh no.
And then you get a bit of a retracement back down to that 1800 level,
Yeah.
and then that's when you really get your rip in the summer or into next year. And
Yeah.
I think that's possible because Jim Cramer's coming out saying gold's a good buy, and whenever he says something's a good buy, it's usually the opposite. So
I don't know what he's talking about, but yeah, I got around 1886 as support, 1910. Again,
this is a 2011 high right here where we're at.
There's a lot supporting this market. The day that silver broke down, gold really didn't percentage-wise do as bad, but but sometimes that's what happens. They go and do a fake out, stop everybody out, and then they take off.
And that monthly candle is pretty strong, and it closes in 7 days. So
yeah,
it's pretty powerful. Like you could just consolidate up there at the 2011 high like this for a few months. I'm sorry, something like this, and then in the summer you get your break of the all-time high, especially on governments amassing it for sure.
All I can say is if there's an issue with the debt ceiling, you could see that happen in one trading day. I've seen gold move up hundreds of dollars a day. So it has happened in the past.
We zoom in way back now. Back 6-month chart. Delete these lines. I mean, yeah, here they were in the 70s. Gold went up 50%. It went up $20. Back then, that percent move, it was 50%.
Yeah, they were bigger
in 1 month.
Yeah.
Yeah, it was an epic gold run for sure. Yeah, in the 70s, that was on the creation of the fiat dollar, basically abandoning the gold standard.
Well, but the other thing was the Hunt brothers tried to corner the silver market, I believe in 74. So, I mean, there's a lot of reasons why things got wacky back then. But yeah, so it'll be, like I said, there's a lot of elements you got to pay attention to. Because right now, even just in the next few weeks, it's choppy. So that's when people can get chopped up, like on day trading and stuff. And that's why I say, like on the silver, you wait until it breaks above the slop before, but it's got a nice accumulation. But you just
look how stable gold was, Bob, back in like the 60s. It traded between like $33 and $36 an ounce. Because
the U.S. had it on a gold standard.
And then going back to like the freaking early 1900s, it was never left $20 an ounce really, except for in the 31, right after the Great Depression, it gassed way up.
But think about it. It was a commodity that they were using, so it was beneficial to the economies that were trying to be formed. The cities, the railroad, anything you used minerals for to keep the cost low. So, and also we probably had a ton of it,
Yeah. Oh yeah.
The
economy was stable.
We weren't getting it from other countries. Think about that.
The economy was stable in the 1800s, in the early and mid 1800s. It really was.
Because it was 100% U.S. manufactured. There was
Oh
no
yeah.
globalization, except for maybe tea from England or something.
hmm Yeah, it's really, really, really interesting discussion when you get into that stuff. So let's see, shown the dollar, shown the stock market. Uh, we didn't really talk too much about bonds, but
No, bonds have been, again, yields have been backing off.
yeah, the 2-year yield's starting to fall. 10-year yield's falling, 30 years falling, but the prices of the bonds are holding. As a matter of fact, the 10-year looks like it's moving higher than your bond note. So, it bounced off that 2020 level quite well. Yeah, I mean, maybe this is the beginning of fixing the yield curve problem.
Yeah, you never know. You never know.
What about oil?
Crude oil, again, I call it in the middle. It's rolling over a little bit here. You got resistance around 82, call it $83, and support around 77.
I'll have to zoom in here to daily.
So again, I think this is maybe a little short-term resistance up here. Nothing major. It's probably more of a bottoming type of
I think so
matter.
too. W bottom.
You need
This is
demand.
just like the end of the sellers probably right here, trying to get out and with some with the break even or some small profit.
You had a few pops because of the reopening talk from China. You need more oil and this, that, and the other, which again, they may. My question I pose is, if the rest of the world's tightening, the demand's not going to be there. So they're basically the manufacturer. So unless they're going to manufacture for their own country, again, that's why I say the rest of the world is going to dictate what China produces. And right now, I just believe the high-end ticket items will probably slow down. But you never know because, Elon Musk lowered the price of his cars. So if you bring, that's good for bringing down inflation. And if you can do it enough, then you got prices going the right way and you can employ people. So, but you got to have the people on the other side with the money to buy it.
Yep.
So again, I'm still 2025 before all this shakes out. So, and the charts kind of are supporting there's potential. If anybody thinks there's going to be a major move up from here, still with a lot undecided, I just think that's not the right way.
Yeah, I mean, you could look at it more like this, where
you could have a month up, up 3% or 5%.
You think gradual up down, kind of just chop up into the side.
Yeah, that's why I say choppy, but choppy usually get chopped up. So I'd wait until there's a definite trend established. And again, crude's going to be one of those leading indicators. So just be aware of that. If you're willing to give more risk up to the trade, knowing that, you're drawing this wedge formation. If you're buying near that support, you can, make that where that last time it touched the bottom, as you could pick that as your stop point. Yeah, right down there. So you determine if that's what you want to risk. And
this yellow line here goes back to, I think it was 06.
Yeah.
I don't want to zoom it out again. I've been messing the chart too much, but just something to keep in mind is that you're starting to build structure above a key level.
Yeah.
So
that's why I say. That's why I say you can buy around there and put your stop down where you break that pennant. You know what I'm saying? Because then that way you wouldn't necessarily get stopped out. Like silver yesterday, if you bring up that chart, you'll see the sideways pattern, and I think it was around 23.25. Yeah, see that accumulation up there? I think the support was around 23.25, and we got down to 80 something on that wick. See that wick?
Exactly.
Right there?
20,
and then it came right back up. So most people got stopped out there because you're like, all right, I know where my support is, and it just ripped right through that. And
hunting by brokers.
But think about it. No, this is a commodity. But think about that as a trader. you want that washout, because what that's done is not only did it get rid of a lot of longs, it now brought it back up to where there should be solid support. So now if anybody wants to get in, that's why I say a lot of people are probably going to have buy stops once we break out past the pennant formation, and that gets up to around that 2450 mark. Because if we close up there, we're off to the races. Now you're going to get a move as high as that width. I think, from 23 to 25, whatever that is, that's the minimum upside objective.
Yeah, you're looking at like a 5% roughly, 4 to 5%. Get above that.
Is that what that is? But
Yeah,
I think it'll go to the old highs right there.
In the past, when it's broken that line, it's done 2.6. Look at this consolidation here, for example. When it gets above it, 3%, 2.5%, 1.7%.
Yeah, see how it did the same thing over there?
5%.
It did the wick, and then it dropped
3%.
under it, and then it ended up being a fail.
Yeah. Yep.
So again, percentage-wise, the higher we go, you'll see silver also percentage-wise probably outpace gold. So, because that tends
good to know.
That tends to happen once these positions play out more.
Yep. Dow Jones. I know we're jumping around here. I just was thinking about this, about how we had broken this key level here, and now we tested it as support, and now you've started a new uptrend on the Dow. So until this level breaks, like it's a new uptrend until this red line breaks. So.
And again, that's why I've said, since the beginning of the year, that could last, into the end of earnings season. So, I know this week and next week we get a slew of them. So, that's into February. You could go mid-February, even end of February on this push. Again, you got the Fed coming out on the 2nd, I believe, with another rate hike. What's more important is, their wording on what they think going forward. The markets are anticipating it's a quarter, and then it's a pivot. As they'll say, it's data driven, and we'll just have to wait and see.
Yeah. So I guess we can. I think I'm going to shift gears now and go a little more into crypto.
That's fine.
It's interesting the way that Bitcoin has reacted now for some time. There was a large corporation, the Digital Currency Group, that they're behind the likes of Grayscale Bitcoin Trust and other things. So they're large players in the sector. They basically announced bankruptcy, and then you see this massive rip on Bitcoin, 40%, from a low of like 16,000 all the way up to 23,000 was the high. And when you zoom out and do some analysis on this chart, Bitcoin has shown its first colors of the end of the bear market and the start of a new trend. So even if you don't go straight to the 50K tomorrow, long term, this is the beginning of the end of the bear. And you're starting to see it on all of the cryptos. If this is your downtrend, we're now posted above it. We finally broke above for the first time since basically since the downtrend started. And it's trying to create support here. And there's nothing saying that this won't, come back down and retest the lows depending on how you draw this formation. But that, Bitcoin looks good, and a lot of the dead weight and bad leverage is out of the system. And Ethereum as well is kind of overperformed in this particular run up, but it overperformed in a bullish sense all year by not making a new low all last year. And now on this particular run, you'll notice that if I pull up the ETH and Bitcoin comparison, ETH is starting to lose dominance to Bitcoin. So when you compare them together like this, as Bitcoin runs harder and harder, if ETH doesn't keep up pace, it's going to start to lose dominance to Bitcoin. And Bitcoin being like the most decentralized and biggest currency, the way that this would play out is Bitcoin would run up to that like 28K to 34K range, which would coincide with the 0.786 fib level before ultimately breaking back down to come back and test these levels that we're at now. And if it does that fast enough and hard enough, Ethereum's not going to be able to keep up, and it's going to come back down and test this low, which would be a really good spot to look to add to your position on Ethereum. So if ETH loses dominance by 30% to Bitcoin, that's about the wick low that I could expect where you'd want to go long. Now, if it, yep,
You got that gap. I mean, you and I are kind of pushing each way on this, but there are gaps. They call it an island, is what formed on Ethereum and Bitcoin. On Ethereum, the gap is around 1467, and I believe you got to go fill the gap before you can go significantly higher. Right now, the support and resistance around 1682, support 14, again filling that gap 1467. I agree that Bitcoin's probably gonna, because it's either Bitcoin moves or the alts move, and Ethereum's held up tremendously well during, I think, the dark last 3 months, better than any of the others. But again, now that a lot of this bad news, all these exchanges and these players are going out, and everybody's even commenting more and more, hey, the regulations aren't because of the crypto coins, it's because of the people behind it. So again, that constitute the technology is viable. It's just get the crooks out of the way. So I think this is kind of a relief rally that if the SEC realizes, it's more bad players than it's a bad, coin scenario, that's going to bode well. And I'm all about the technology.
Stephen Beers says that he asked a question, is it possible to bounce on the top of the Bitcoin channel? Yes, it is possible. So you could see a failed breakout and then come and break down and test this. And you could even see something happen later on this year where, you trend up, back up to this level, and then you break down again. And then you do have some sort of capitulation wick where you come all the way back down into the channel, and then smart money comes back in and just launches the thing back out of here. We've seen that before in the past, something like this. Then it'll start back up. So that would be more like a double bottom or triple bottom. If you consider this bottom one, bottom two, you get a triple bottom on like a wick. Yeah, that's totally possible, and that's honestly I got a high probability of that happening just because of the pressure coming from the macro.
Well, you could also get a double move of what you just had straight up. If, again, I keep going back to this, if there is no extension of the cap on spending cap, again, the integrity of the dollar, that means we're going to default. You don't think cryptocurrencies are going to be where people want to be, and that's even going to help. China and Russia want the U.S. dollar not to be the dominant world currency. So that would just feed right into that if we don't, again, protect our debt. And that requires Congress to work together. So I guess we're putting our faith in Congress, whether, the dollar becomes an altcoin and Bitcoin becomes, a primary. So you just don't know, but that's what I believe is what's at stake this year. So that's what's kind of neat. There's a lot of different variables that can really impact markets either way.
I'm trying to decide what I want to show because there's a lot of different indicators that I can pull up here to give you guys a more honest look at how Bitcoin's starting to bottom. One of them was if you go back to 2015. If you're a believer that what happens before it can happen again, this bottoming period here in 2015 is not that much unlike what's happening now, which it wouldn't be a straight up and go type of situation. Basically implying that you sold off 2015, and you got your rally. And so then this rally is actually overperformed, and then it comes back down to chop back, test the lows, and then we spend like the whole year basically fighting with 25K under like some similar situation like this. And that's okay. Like that's great accumulation range for people to accumulate Bitcoin over the long term within like a $5,000, $6,000, $7,000 range before ultimately getting out of here at the end of the year, going into next year. And then you create this large pennant structure. ascending triangle. Fully possible. And honestly, probably highly likely. And it's funny because Hex is actually doing that same chart pattern as Bitcoin did in 15, and I'll show it to you. I made a tweet. I'll just pull up the tweet. It's easier. Yesterday, I think it was. And it basically just compares that 2015 cycle on Bitcoin to what's happening now on Hex. So like you just had this giant red downtrend, and it took 686 days for Bitcoin to finally break that from the high in October, November of 2014 to the following. Was that 1, 2? Yeah, it was like 2 years. And so like Hex is just giving you a sweet accumulation period here in that same way. Uh, for the Hexkins in the chat, I think it looks good like for this to play out this way. But because of the low liquidity, I don't know if you guys caught from the Hex conference. But because of the low liquidity, it can move faster and harder. But just noting on like what the on-chain stuff's saying, there's not a lot of sellers left in the system. Like a lot of that stuff's been washed out. And like this chart here will show you in blue the liquidity setup. The way this works is where the bigger blue bars are is where more liquidity sits. And so if there's no blue bars to the right of the price here, that's where the price can move a lot faster. And so what I have here in this white line is what I call the liquidity gap. It's a spot in the price between 2.9 cents and 3.3 cents where it basically is like the line of scrimmage. Like if the price gets above it, this level up here has more liquidity, so it's going to be harder to push through it because we're in a downtrend. But if you get above it and you push up towards 5 cents and you come back down, that then becomes an accumulation zone where all that liquidity is. Whereas if we never can quite get above it in the liquidity gap, we spike up there and then we fall back down to these levels, that's telling me that opportunists are taking profits inside of this big liquidity zone where the bars are the biggest. And so that means that the bear trend can continue. So what I have played out here over some time is Hex price kind of just consolidating inside of a rising channel between the very low liquidity of the bottom and the medium liquidity here in the middle. And then once it finally does go to break that gap, if you get some whales to push the price through the thickest liquidity, it can then come back down to test the thicker part of the band, and then we can start to build structure going higher, which is kind of how this chart comparison with Bitcoin would play out over the next couple of years. This would basically have a price going up to like that 3.5 cent range and just struggling with getting above that liquidity gap for some time. But sometime in the middle of the year, end of year, then you get your real good push higher, maybe on a pulse chain news announcement or a documentary announcement or something like that. So that looks good to me, and it's just it's so down so hard, and it's got product market fit. So I think now's a good time to be looking into it. This is like Hex on the 4-hour chart, and the RSI is above the 50 level on the daily. Or I'm sorry, on the 4-hour. And so like when you're trading above that, you're actually in a bullish trend. And then price itself is sitting like at that 2.5 cent level, and it's actually still in an uptrend. It's been able to trade inside of this tiny little band and hold its position. So that's bullish because this guy here that sold 150 million Hex, he affected the price chart for minutes, and then that was immediately bought back up. So even now the price is like barely moving, and there's like not a lot of volume coming in today. The buys are still outweighing the sells, 171 to 127. There's been almost $900,000 of buy volume today, and only $650,000 of sell volume. So the data that's coming in is telling you that the trend is starting to change, and that the big bags who dump are running out, and that the small fish are coming in to buy up the bags effectively. And then looking at the Hex derivatives, this is basically the icosahedron ecosystem that's built on top of Hex. The hedron price down here, let me maximize it. it's playing around with that 21 daily level. Actually, let's see. This is the 3-day. Let's go to the daily. So it's playing on the 21 daily. And it's actually trying to get above and hold support to try to come up and test the upper side of this band. If you get above that level, that actually coincides with the 0.618 fib level, which is a key significant harmonic. And then bouncing off there, the price can rapidly move to the upside just because there's not much liquidity out there. And then if it fails to get above and hold, easily can come back down and test the OA wall, where there's the thickest liquidity against hex. And some large hex holder can come in and accumulate tons of hedron at this price because the liquidity will be there to support their bids without incurring slippage. So that looks good on hedron. And then Icosa is already in an awesome uptrend. Like this has been a great chart to trade. We called for some good stuff to happen somewhere back in here when we started to break this moving average. I think it was on so that was the end of December. It's January 2nd and 3rd in our private Discord group. We were saying that you're starting to play with this 21 moving average, and then look, we had a nice clean bounce for an automatic 46%. Came back down to retest, held it once, held it twice, 3, 4 times, now 5 times. So it's because of the low liquidity, less than 250 grand in the pool. It doesn't take much to push the price up, and there's just not that much to sell because the circulating supply is tiny. So this thing can rapidly go to the upside, and I think like right now at the current hex price, like around $1 might be the ceiling limit for price. I have to check Crypto Sloth's. Oops, wrong chart, wrong website. He made a website recently, which basically shows you how to calculate where the ceiling price would be during times when hex price is at 2.5 cents. You could like, let's see here, hedron hex price 0.025, T-share rate is like 25,650 roughly right now. So the ceiling price right now for hedron is way higher, like way higher. Like that, there's no ceiling in the way. Whereas like Cosa, I want to say we checked it, I think yesterday or 2 days ago. I want to say it was like around $1. So it's not quite $1, 89 cents. Let's see, I think 89 cents. So yeah, that dollar range would be where people can start to try to arb the price by the HSI auction system. So, but yeah, the move to 89 cents is still another 50% move higher. So I've seen this chart pattern before on Hex where you had that initial impulse and then a sideways chop in a ascending triangle, and then it just freaking ripped. And I'll show it to you now. If you go back to a 4-hour chart on Hex going all the way back to Big Payday, there is a point in time where it forms the exact same chart pattern. And because Icosa and Hedron are derivatives of Hex, you could assume, assumptions may kill, but in other times they're very profitable, that this same pattern, where you get the rip, and then you get the sideways chop into an ascending triangle, and then you get the move higher. This was what took Hex to a 1.5 cents for the first time. And so to think that Icosa couldn't also do a similar move off a similar pattern would maybe be not the right way to look at it, especially considering that the ceiling price is still 50% higher from here before people would want to sell for profit. So yeah, so that's that stuff. Obviously I'm super bullish on the ecosystem. Here's the perpetuals for the Hex perpetual. So the Maxi's the 15-year stake, Jesse's the 10-year, Lucky's the 7-year, Trio's the 3-year stake, and Base is the 1-year stake. And Base being the one that comes up the soonest is actually trading at a slight premium, like a 0.5% premium. And the longer, the 3, the 7, and the 10-year stakes are trading at a discount. So I wanted to actually show you this, Bob. It's pretty cool. Which these tokens do, they're redeemable for like the length of stake that they're staked for. So if you notice, the 10-year stake is trading at a discount. If the yellow line is 1-to-1, 1 hex to 1 deci, or in this case, 1 hex to 1 lucky, or in this case, 1 hex to 1 trio. It just means that those longer term investment stakes, because there's just a lack of conviction in them, or like they don't mature for like another 9 years or 6 years or however long. People are allowing the price to fall on them because they're not selling them. There's just not a lot of volume, and those that need immediate liquidity are leaving the system. But this is in effect an inverted yield curve. This would be the equivalent of the short-term yield curve, the short-term bond, and the bit, and like the 1-year stake is paying a premium versus 3-year stake, which is a slight discount, versus the 7-year stake, which is a more major discount, versus the 10-year stake, which is a significant discount of 10%, going on 11%. So you can actually get more hex if you buy Deci, which is a locked 10-year stake, than you can by going and buy hex off market. And so what my thinking is that this is just opportunity, and that the market is actually mispricing these perpetuals right now, and then that in the bull market the same will have the same effect to the opposite direction, that it'll go into massive speculation, and you'll have some sort of big premiums on these things in the bull market. So like buying them at discounts now might be really, really valuable come bull market time. The reason why I think that is because the very first one, which was the 15-year hex stake, and it's called Maximus, that thing went up to a 2.5 times of a hex, and it peaked in September of 2022. So last September, you could get 2.5 hex for every maxi that you held from the beginning when it was at 1 to 1. So these huge speculative runs, the upside and the downside, are part of the game, and it's something to keep in mind going forward.
That was pretty interesting. Thanks.
Yep. Just to prove, not to prove, but to close out that comment on the inverted yield curve, I'm going to pull up a recent chart set from our private Discord, and this is before we close out today. I just wanted to kind of go over AXiSAlive.com slightly, just for maybe just a couple minutes, because I did do a display of it the other day. But inside of there, you're going to be able to get access to daily or maybe every other day chart sets that'll be uploaded. And so this is kind of the format that I go by. Like we go over like different charts in sequence. So like we'll start with like the dollar and give you some annotations on what's going on in the dollar chart, gold, copper, crude, bonds, stocks. And you get into the crypto market cap. Like we'll look at indexes of crypto, and then we'll look at the stable coins, and then we'll look at like the big major cryptos, and then they breaks down into like different cross analysis on like Ethereum versus Bitcoin. We got Hex in here, a couple different. Like in this particular chart here, you can see that we're measuring historical volatility, and that it's getting squeezed down into a channel, down into a point, a key point that's coming up in the next 238 days, where eventually X is going to have a huge volatile bust up, out, or down. And so we're looking at that in the next 238 days, for example, or just like measuring this RSI fractal. So like just imagining that if this were the bottom, the kind of volatility that would come in with this squeeze to see kind of what price would do in relation to those moves. And then we do cross analysis on all that data and try to give you guys an idea of what can happen in the future. I got a hex liquidity data in here that basically shows that we recently broke out of what was a multi-year. It was like 500-day, just short of 500 days of just a giant liquidity squeeze, and now we finally had a breakout moment on that. And then just kind of just going over that data. We go over the icosahedron data. We talk about some crypto airdrops that dropped at hex stakers, the Maximus DAO system, communists. This is a cool chart because it shows you this is the communist airdrop, and you get to see kind of here the multiples off the bottom wick. Like it's funny because not many people knows about communist, but it's already traded inside of a 7x range. So if you traded this chart, you could make anywhere comfortably a 2 to 4x comfortably inside of this range. Granted, the liquidity is pretty low; it's only 140 grand, but put in $1,000 on the low and you take 3,000 at the top, that's still money. So I mean, it's something to think about. You know, the price is getting squeezed inside of this. So I give you some trajectories on that. So when you sign up for AXiSAlive.com, you're going to be getting access to daily charts that updates. You're going to be getting access to blog post from Bob and myself. Here's the website, seen for the first time, second time. And all this stuff's going to get updated. And, there's other things in here, like all of my great long presentations, my multi-hour long presentations. Most recently, we did one with Bob and Randy Holarski on his channel called Fiat Fallout. And if you haven't seen it, go to Randy's channel and click on Ignore Macros and Cycles at Your Own Peril. And that was with two of them. And that was a really good 2-hour stream where we go deep into the macro economy. So all that will be on the website as well. And under services, we'll have classrooms, consultations. There'll be private sessions with Bob and a few other experts in their field. We'll be doing that at least once a week. And then there will be a resources library where you can come in here and you can learn all kinds of information. This is free to the public, on technical analysis, markets, different tools, and then just different articles and thought-provoking ideas on philosophy, and science and spirituality. And then rounding it out, we got some book suggestions for you guys if you just want to go straight to the literature and read it for yourself. So I'm excited to launch this website. It's coming. Coming actually in like 5 days. So keep on the lookout for that. The charts are going to be on there. I'll always be a public figure. I'll always be giving stuff out through Twitter. So if you want to reach me, you can reach me on there, or you can subscribe to my mailing list. Looking forward to working with everybody and kind of see where this all goes in the next few months.
You're here.
I'm here. Yeah. So there's no. Let's see. I gotta go back and see what kind of questions we had because I had kind of been on a ramble here for a minute. Let's see. Retest with triple bottom and to confirm bottom, then off to the races is my bet. Capitulation wick down to 11K BTC, then V straight back up. Totally could see that happening. So if I pull up the Bitcoin chart here, there's no reason to think that's totally in the realm of possibility. If this is just a falling wedge, something like this, you come back down to test the lows for a triple bottom and just rip right back out. That's very likely. Or max pain would be you go right up to 34K, trade sideways, then you get your nasty spill back down, something like this, and start to build your way out.
And just to let you know, again, it's also has to do with identifying chart patterns. This doesn't really look like a chart pattern of a bottoming. Just like we're going to really take off from here. That it's just generally not how a constructed low in any market works. Usually it's pretty clear. And again, this just looks like a slow bleed, and now you may have gotten some short covering. That's how I read this. I don't believe anything's going to be sustainable longer term. Like you said, if we can get up to 30, that would be an amazing rally. But again, we'll see.
Mm-hmm. I will say to that point, this is the 2018 bottom. So like this is kind of, Bob, you can see my chart here.
Yeah.
You see how like in 2018 it kind of created like this weird. This was the structure you got off the bottom. Something like this. So even though it broke trend here, it still ended up somehow. This was the bottom in 18.
Yeah.
And so like if you, thinking about, is this similar to that? If it is, then you had the same sort of, in a shorter amount of time, the same freaking pattern.
Yeah, well, it could be, but the dynamics were a lot different too. Money was going even cheaper back then, and the dynamics have totally changed. So, yeah. I mean, if you believe that crypto is an asset value class, in other words, it doesn't have a correlation with interest rates, then you could say, yeah, this could go straight up. I believe every asset class has a correlation to interest rates, and it's reflected in its value. It's just going to be hard. Again, what's happening now is each asset class is competing for your dollars, investment dollars. And then so much of it has been taken away from government debt, these I bonds and, these tips and, nice yielding stocks. I mean, there's a lot of international. So there's a lot of dynamics that are are basically pulling the liquidity into other asset classes that have less risk. So again, it doesn't mean that it can't have a run. I just think again, right now there's still elements that need to be settled. Like I said, this could take off if all bets are off. If they allow the deficit ceiling to pass and we default, I could see Bitcoin at triple digits. I mean, that's how fast I could see that happening. So that's why I say we're in a totally different dynamic now with the politics that are controlling, whether we default on our rates or not. So like I said, stay tuned.
The question was, what's your thoughts on flipping fractals depending on the current economy? I'm not really sure what you mean, flipping fractals. Not sure. If what you mean is more downside, that's totally in the cards. You're still in a bear market technically. So there's just a lot of signs coming in that's coming to an end, but that doesn't mean that it's over. Just because you're out of a bear market doesn't mean there isn't 1 to 2 years of pain. No. All right. Well, sounds like a good point to stop. Appreciate everyone for being here. Bob, thank you for sharing your time with me.
Thank you. Thank you, everybody.
All right, we're taking off. Good to see you guys. We'll be back again in the future. Thank you.